Okay, so I thought I'd be bold enough to try and explain leverage that Justin was struggling to, thought he was struggling to explain, because I'm a qualified accountant, and to be honest with you, I had to reevaluate my appreciation of leverage from a trading perspective. But essentially, my take on understanding what has been explained by Justin, most wise and profitable, is that it's about position sizing. So if we want to put on $1,000 worth of gold, okay, then on the actual exchange, in the UK you can change leverage if you want. Sometimes it's fixed. So let's just say that the leverage is 10 to 1, 10x. Okay. Well, if you want to, or not if you want to, the focus should be on position size, because ultimately the deal is, I'm going to put $1,000, hope it goes up 5%, and cash out with $1,050. Period. It doesn't matter whether I've put £100, or dollars rather, into the deal and borrowed 900. However, my funding mix on this deal, on this setup, is structured, is irrelevant to the fact that there'll be $1,000 in the market, and I hope it goes up by 5%. Where leverage is relevant is in the margin that you need to put up at the exchange. So generally, you'll have an initial margin and a maintenance margin. And on 1x, it's a certain percentage of the £1,000. So let's say it's 20%. So the margin is 20%. I keep saying pounds, I mean dollars. That's 20%. So if we were not leveraged, we would need to put 20% of $1,000 to cover the initial margin, which is 200. Now, we also have some maintenance margin, but let's just keep it simple. If price goes up and we're not leveraged, then the amount of margin we need to cover if price does go down has more elasticity. And what I mean by that is, if we've got £200 on exchange to support this deal at 20% margin, then price would have to move down from $1,000 to $800 before our stop loss would get hit. So that's a 20% move in price. If we decided to still place $1,000 and still hope for 5% return. But we funded the deal differently and said for the $1,000 that we want to fund, we're actually going to borrow we're going to borrow 500 on leverage. So we need to put in the initial 200 for our original margin. Let's call it 600 to make the numbers easier. And then we've got a 3x leverage. So we would have to take half of the 2x and half of the 3x again, which would be another 100, another 50. So because we've borrowed $600, we need to put in margin of 350. Now, what that means is, in order for your stop loss to get hit, you have to maintain £350 of margin in the deal, because you've got to maintain the margin of the money that you've borrowed, as opposed to £200 of margin when you fund the whole deal with your own capital. So because you have to fund more margin, it means that as price moves against you, it doesn't need to drop the full 20% to hit your stop loss. So your equity available on the transaction is reduced because you're borrowing the money, but the margin you need to pay to cover the money you're putting in, and I suppose the money that the leverage provider is putting in, means that your stop loss is much more sensitive to movements in price. And that's the only difference, as I can see it. Fundamentally, forget how we're funding the deal. We want to buy $1,000 of gold, and we want to make it 5%. How that $1,000 is funded, i.e. all my money on 1x or 100x, doesn't change the fact that we're shooting for 5% on $1,000. I don't know if that's helpful. Bye.